right, welcome to Retire Right, a Wyze Wealth Advisors podcast. Today we are going to be talking about investment planning and what that means. More specifically, we'll talk about, we'll give you our perspective on it. We'll be talking about our investment planning approach, etc. Joined today by Ron Wyatt and Nick Lewandowski, both wealth advisors here in the Pittsburgh office of Wyze Wealth Advisors, and also both on the investment committee. So figured they were really good guests to have on today. Guys, thanks for joining. How you doing?
Great.
Doing well, thanks.
Thanks for having us.
I know you heard the introduction, so we can just jump right in, but I want to start, very high level. Both of you could just really give your take, like what does it mean to have an investment plan, and why would you say that it's important?
Let me start off. So the investment plan needs to be connected to the financial plan, right? Financial plan. You have to have, when your goals are, right? When you want to retire, how much income, do you want to leave money? What are your goals, right? Regular spending, travel, a legacy. And so once you have the goals, you look at your resources, right? So some of the resources would be, Social Security and pension, but other resources would be investments. And you see the gap from those fixed resources like pension and Social Security. And so we can back into what the investments, the return that needs to be generated to achieve someone's goal. And so what we're trying to do is to achieve people's goals in a manner that allows them to sleep at night. So they're connected, and that's the way it really should be. Nick, would you like to add anything?
Yeah, so I think the other dimension to an investment plan is that it's kind of like your North Star or your home base for your portfolio, right? Like there's a lot of uncertainty in the world, markets are constantly changing, the news is scary, and there's always the temptation, if you don't have that home base or North Star guiding you, to start to mess with stuff. Yeah. And my experience in the industry and from the research that we all put a lot of stock in to build our approach is that whenever you start to make these emotional, finger in the air, gut decisions, the outcomes are not great usually.
Right. Yeah, studies show that people who have a financial plan are likely to stick with their investment plan, meaning don't get spooked out of a down market. And I've seen that with my practice is that people who, focus on how the investments help them achieve their goals, how it fits together as a puzzle, tend to be able to think long term. The people who focus day to day on investments and they lose track of the plan or don't have a plan, a lot of times they can be more emotional and more likely to panic.
Let's expand on what you just said there. How many people, both of you again, I want both your perspectives on this, but how many people, let's say before you started working with them, so you meet them, you guys have a sit down meeting, go through their situation. How many of them have had a well-crafted investment plan before you started working together? And then in addition to that, kind of the second level to the question would be, have you noticed any consistent themes with people that you meet for the first time?
Well, since I have more experience, let me talk about the how many people, and then please add to it, and then talk about some themes. But I've met a few people over my career that have actually had decent plans, but it's been a few. And most people just have investments, kind of think of it as you're closing your closet, right? You buy this outfit, and then all of a sudden it's a mess in there. You don't know what you own anymore, right? And sometimes portfolios are kind of that way. So they're buying individual good holdings, but 5 and 10 years later, what do you have?
Right.
Yeah, I see that a lot. So Nick, would you like to expand?
Yeah, no, that's a big theme, I think, for everyone. I guess another theme that I would mention is that a lot of times people don't have a comprehensive plan, so they don't necessarily realize how much they have in cash maybe sitting that's not very productive or that might lose to inflation over time because they're not building a comprehensive report and allocation to take all their stuff into consideration. The other thing we see sometimes is that folks who like to pick stocks and things like that, sometimes maybe versus what we think is prudent in our approach, go overboard a little bit, and
Sure.
they want that NVIDIA, they want that lotto ticket, and there can be a time and a place for that depending on your goals, but you have to make sure that there are some guardrails around it.
So far it sounds like some of the consistent themes that you've noticed is, for lack of better words, kind of a hodgepodge allocation.
A lack of systematization.
Okay.
Right?
Oh, nice.
Yeah, like we like to be,
I wouldn't be able to say that 3 times fast.
Our approach in all our material and in all our conversations, we really emphasize, and even if we're not saying systematic, we're saying systematic like with other words. Like it's based on rules, it's based on guidelines, it's based on data. Systematic. Take the emotion out of it. Take the fuzzy judgment, out of it.
Yeah.
And the other thing, Nick had mentioned it. Let me expand upon it. But people a lot of times will chase what's popular. Like EV stocks or cannabis stocks or AI. And sometimes if you're early enough, you can make money with those themes. But a lot of times people jump in based on the theme alone, and they don't pay attention to the price they're paying. And you can get a great company, but if you pay way too much for it, your returns could be rather poor.
Sure. So can you guys just hit on why a investment plan, or maybe even how an investment plan should fit in or coordinate with a financial plan and a tax plan? Because I know, and I've even recorded episodes on that in the past. I've recorded episodes on our financial planning approach and our tax planning approach. But maybe just explain how the investment piece fits into that and why it's really important.
Let me try to take a big picture, and then Nick, feel free to drill down on anything. So first of all, with the investment plan, as I mentioned, you should have an idea of the return you need, and there's a corresponding risk. We can actually show you historically a portfolio what type of risk it's had, right? So what we do is, first of all, we ask, this risk, 20% downside, for example, can you handle that? But we also use a risk profiling tool to come at it in a different way. So what we're trying to do is make sure that those fit together. The return will achieve your goals and you can sleep at night, okay? If they don't fit together, then we have to have a conversation about trade-offs, right? Are you willing to take a little bit more risk to achieve the goals? Are you willing to cut back on goals, right? So that's really the first step.
Right.
So once you have that, then you do your asset allocation, right? How much in cash for liquidity, bonds for income, and to cushion the stock market being down, and how much in stocks, right? So once you have that allocation, then you pick the investments, and then you have to monitor the investments, which we can get into that in more detail. So that's the overall framework. Did you want to add anything to that?
I'll touch on tax a little bit. Tax planning is super important. But it's also important to draw a balance between good investment strategy and tax efficient investing and tax planning. Everyone has a bit of a different personality around taxes. There's people who are totally ignorant of the impact taxes have, which is not good. And there is the personality type that I maybe unfairly say I would spend $1.10 to save $1 in taxes, which can be counterproductive as well.
Right.
So as advisors, we're trying to integrate both together, right? Like tax efficiency, prudent tax planning, all else equal, we want to keep taxes as low as possible, and all else equal, we'd like to pay no taxes. That's not really realistic.
Right.
So our goal as advisors, and everyone's goal if you're doing this yourself, should be to really balance the trade-offs. Like Ron was talking about trade-offs in the planning context, we have it on the tax planning side as well.
So to take that one step further, let's just say that we have a client that has money in qualified accounts like an IRA, and then also in taxable accounts. In the retirement accounts, we could put in, for example, a stock strategy that might have trading. It might generate gains, but in an IRA, it doesn't matter.
Right.
In a taxable account, we may use exchange-traded funds that are much more tax efficient. So that's kind of how we can address that issue.
Yeah.
Okay?
I like to look at it this way. This is more on how the retirement planning process kind of feeds into the investment planning process, but the more comprehensive or the more thorough you are with your retirement plan, look at it as a puzzle. By being thorough on the retirement planning side, it allows you to back into very small pieces of that puzzle and answer those questions. For example, what Ron kind of said this a little bit earlier, what required rate of return do I need to achieve my goals? Once you know that, you can come up with what an asset allocation should look like for that required rate of return. You assess risk tolerance. You find out how comfortable somebody is taking that risk. Maybe they perfectly align. Okay, that's good. Maybe they don't, and you have conversations there. But the more thorough you are, the easier it is to back into those small pieces of the puzzle.
Yeah, so I gave the framework. I don't know if it's appropriate time now or not to talk about. I mentioned about knowing the return needed, asset allocation, picking the investments, and monitoring. Is it a decent time to talk about like the monitoring part now?
Yeah, I'd say monitoring, or even I think maybe the question that I would have is like when should an investment plan be changed?
Okay.
If the dock workers go on strike, is that when I change it? When do I change my investment plan?
Before I get to that, there's two beliefs, and like two broad beliefs, right? One is I can time the market, and one is I can't. I need to have a disciplined plan. Now, timing the market means that for example, the market's going to fall, so you're going to get out, and then you're going to get back in near the bottom before it goes up.
Strong emphasis on
Yeah, exactly.
You're predicting the future.
Right. But the thing is, we don't know, and most people look in a rearview mirror, and when the markets are already down, they get in panic mode to sell, and then after it's recovered, they're like, well, sometimes they have a hard time getting back in because they can't buy higher because they sold lower, right?
I've seen that firsthand.
Yeah.
I when I used to work at Schwab, I met a guy that sold probably during 07 to 09. He went to cash or CDs, and then in 2020, 2019 is when I met with him. And he never made that decision to go back in
because the prices were higher, right?
Because exactly.
Yeah,
it's scary, that double decision that you need to make, because you need to be right on, if you're going to try to time, you need to be right on both.
Right. And I joke around by saying, a crystal ball, right?
Yeah.
We don't have a crystal ball. So if you expect us to have one and to be able to time, we are not the firm to work with, okay? Let me make that really, really clear. Now, Ryan and
I have it, but I put you guys out of a job, so I just keep it
holding back.
Yeah, you promise all you want, Ryan. Yeah. So that's the crystal ball approach. The other approach is I tend to be a pretty disciplined person, and the other way is say, hey, I don't know what's going to happen, but it doesn't matter. If I have this plan, so for example, say that I had half in stocks and half in bonds. And let's just say the stock market goes down a lot. Then what I do is I trim some of my bonds, hopefully at a higher price, and buy stocks low, right? So you're basically rebalancing, right? So what you're doing is as one asset class is getting cheap, you're trimming an asset class getting expensive to buy the asset class, or adding to the asset class getting cheap. It's a forced way of trimming high and buying low.
Yeah.
And that's not just with stocks and bonds. I mean, that's different types of stocks, different types of bonds. It's much more detailed than that, but that's the general premise of it.
Yeah.
Anything?
Yeah, no, Ron covered it very, very well. There's a couple things I would add. We've talked so much about comprehensive financial planning because it's so integral to what we do. So in the financial planning context, if you have a big change in life circumstances, not when the dock workers strike, but if you're a dock worker and you get fired because management's not happy about you striking, that's a time to revisit your portfolio and your investment plan, because maybe your goals and your risk parameters have changed and your whole portfolio needs to shift.
Exactly.
And another one would be I want to talk about, and this is maybe a little more down in the weeds and nuanced, but we think about it as professionals. We don't want to predict the future in terms of the direction of markets today or tomorrow, but there are structural changes in things like tax laws, things like how investment vehicles function. We just did a podcast on mutual funds and ETFs. And sometimes advances or changes in law or what types of strategies are available mean that you should adjust the plan a little bit because you have some more options or some different options.
Right. New asset classes, new products.
New asset classes is another good one.
Take it. Well, I guess one thing, just to kind of make one final point on this question that I'd also want to stress, is that changes to your overall asset allocation is not, we wouldn't consider that like a market timing type decision. Yes, that's a change to your investment plan, but it's not a market timing decision. For example, if we we work with people that are 50 plus with a goal of having 1 million or more saved for retirement. So a lot of our client base is still working. When you're 50, you can take on, let's say you want to retire at 62. If you're 50, you can take on more risk than somebody that's 62. So over that 12-year span from 50 to 62, you should be decreasing risk as you approach. That is having an investment plan. That's not, and that, yes, it is changing investment plan, but it's not market timing. It's just being strategic with decreasing risk.
I was just you asked a question earlier, when do you decrease it? And that's exactly when you decrease it, based on your goals,
Sure.
right? So, for example, if someone's going to retire in, say 5 years from now, and we're in a bear market, we may say, let's hold off decreasing risk.
Right.
But if we're in a bull market, say this is an appropriate time.
Sure.
So what's really nice is once you have the investment coordinated with your plan, if your plan's probability is really, really high, it tends to be when the markets are doing well, the stock market, and that's kind of gives you the indication this is the time to decrease. So,
Right.
so it's not market timing, it's based on goals, as Nick said, also based on new available asset classes. And one thing I'd like to add is we don't do much of this, but we do some of this in our framework, is that you can look at expected returns, right? If 10-year bonds at one point in time, not too long ago, were yielding under 1%. That's not very attractive. And it doesn't, it's pretty straightforward that if you buy a 10-year bond at 1%, you're not going to earn much money. So what we'll factor in also is expected long-term returns, 10-year returns. And we might bias the portfolio based on that, but it's not really market timing. It's just saying over, an extended period of time, this asset class has a, better potential than another one.
Right.
And the other thing I would say in relation to expected return, we base those, just first of all, they are small adjustments typically.
Right.
And there's a very well documented and validated with kind of data research framework behind that. It's not Ron thinking he's a big CNBC guru getting up and saying, I think expected returns will be crap over 10 years.
A great example is I started using private
Kramer.
debt. Yeah, exactly.
He puts up a list of stocks that he recommends.
Ron's throwing cows over his shoulder in the office.
Well, I do that too, but not in this podcast. But what I was getting at is that we start using a private debt fund when interest rates were real low, because with the private debt, as I mentioned, there are adjustable rates. When inflation and interest rates went up, the price of the fund did not go down. What happened is they start paying you more. So the initial yield was very attractive, and under the circumstances, it looked like a great investment to hedge increasing interest rates, increasing inflation, and it worked beautifully. So that's those types of changes we've made. That is related to expected return and a new asset class becoming available.
Sure. Simplest way to summarize that, and I have one more question for you guys, but it's we use goals and where our clients are at, in their life or on, or depending on the timeline of where they're at and achieving those goals, we use that to kind of inform our investment making or investment planning decision process, not, headlines or, what you see on Squawk Box in the morning.
I don't watch it. I couldn't tell you anything on CNN.
I do.
I do
wake up
as
in the
well.
morning and have my coffee.
Yeah. Final question. I just want to hear from both you guys. But what would you say makes our investment planning process unique? And if maybe just so that we're not redundant, if you've already said something, maybe just briefly highlight that, but really focus on what makes our process unique.
Well, I know Nick's going to answer, and it's going to be me. He's going to say Ron.
Ron Wyatt, market wizard.
Yeah.
I'm done. Go ahead, you start, and I'll fill in this. I'll let you say.
So we have this all-season strategy, and what we're trying to do, if you really think about what can happen, the dock worker strike, there could be high inflation, low inflation. I mean, there's could be a recession or whatever, but at the end of the day, what can happen is the economy can get stronger or weaker. Inflation could go up or down. I mean, that's all these variables, wars, recessions, strikes, all that stuff. That's kind of what can happen.
Sure.
Right? So we have a framework, and we try to position assets in such a way that no matter what happens with inflation or with economic growth or lack of, that our portfolios have some things that will be protective and hopefully give people a smoother ride, a more consistent return,
Yeah.
a decent return, still a good return, hopefully, but a more consistent one. So that's one of the things I think makes us really different.
Yeah, I mean, so I joined the team here more recently at the beginning of 2024, and I was coming here. I had some planning and advising background on the planning side, but the last several years of my career have been more on the investment research side. And I mean, I can't help but make it sound like a commercial because, like, of course, I'm going to say nice things about us, like on our podcast, but I don't mean it that way. I mean this honestly. You know, when I met with the two of you when I joined and learned more about the investment process, for a firm serving the client demographics that we primarily serve, our investment process and the thinking that underlies our investment process is like institutional grade in terms of the type of thinking that goes into, you know, these teams of CFAs that manage, you know, pensions, endowments. Like I firmly believe that the same underlying quality, like philosophically and in terms of following research and things like that, are present at this firm. And I've had some experience in the industry and enough experience to know that that's not always the case. I mean, and if anyone, I don't know, compliance would have to weigh in, but if anyone wants to verify that by looking at Ron's academic white paper SharePoint folder. I mean, you know, when I started at the firm and I was still getting up to speed, he would send me, you know, read this 50-page paper about the profitability factor in returns, you know, like it's not for show, you know, like what we do is based on all of this. And it's even in larger institutional research environments, sometimes a lot less effort seems to be going on than gets put in.
I've turned into a real geek. Yeah, I like reading white papers on the weekend.
Well, that's why I wanted to have you guys on today.
Hey, one thing I know that you really want me to touch upon is our stock strategy also makes us unique.
I mean, that too.
in our IRAs. But that's a whole different topic.
Yeah, and we're going to get into that. And I know we even talked about the all-season, you know, framework that we use to make allocation decisions, but I mean, that's something we could do a deep dive on in itself, so we'll do that in a future episode as well. But I really wanted to focus on a higher level today. You know, what is investment planning, why it's important, when you should change it. If you're curious to see you know, how your investment plan fits into a financial plan and a tax plan, please go to check out our company website. It's in the link in the show notes. You can go to the free retirement assessment page and take the first step by booking an exploratory call. We take 20 minutes just to see what your objectives are and educate you on our areas of expertise. Assuming there's a good fit, we can take a deep dive and learn more about your situation and actually put together a preliminary plan for you. So we appreciate you listening and hope you found this episode informative. Also, thanks for joining again, guys.
You're welcome. Thanks for having us.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.